Hello all. So in the present batch, what has been planned is an exam-oriented batch for CMA final only in relation to international taxation. So once we were having interactions with many students, we just found that students are finding it difficult to study and retain the concepts of international taxation, primarily because it is a very vast area, but unfortunately many of us are not getting highly exposed in the area in our during our articleship or in the place where we work for us to understand the nuances of this subject. So basically international taxation is an ocean in itself. I'm not what to say making you get a fear on the subject, but I'm just trying to explain its significance, right? So international taxation as a subject is very interesting, highly evolving. It is not fully evolved, it is highly evolving. That too with the pillar 1 and pillar 2 proposals which is yet to be implemented. Some countries have implemented pillar 2 but others have not. So this is a very interesting area, and it is an interesting area of practice in future. So in the course of CMA, and as once we qualify CMA, so basically even though other chapters of this international taxation you might not use it on a daily basis, but this transfer pricing part, right, you might use it on a very daily basis, and you might be the best persons to give inputs in this area to the person who is going to handle the case with the department, or who is going to determine the transfer pricing policy of the company, right? So this is from the practical point of view. From the examination point of view also, this specific chapter is going to give you some good marks, right? So if you just see the two areas, like the two past papers which is there with us in the new syllabus, somewhere around 23 to 26 marks are being tested in this one single chapter. The primary reason for testing that much is because they feel, as a qualified CMA, you should have the complete application oriented knowledge of this chapter. Leave out the other chapters. For this chapter alone, you should have the application oriented knowledge. So that is the reason why this is being highly tested. But I'll tell you, this is a, I won't say this is complicated. At least at the examination level, it is not complicated at all. But once you understand the subject in the way it should be, it is a very easy, smooth sailing chapter. So whatever marks they are going to ask, 23 or 26, so of this we can easily get 20 to 22 marks. 20 to 22 without doubts we can get. Anyway, Pathana, there are some areas which are quite easy at this place itself. If you just see this point of associated enterprise, the 6 mark question which was tested in June 23, then this computation of ALP, and this is going to be there in every attempt. So you can take my words. So this specific area, computation of ALP using different methods of transfer pricing, is going to be there in all the attempts. Next, this APA is more a theory oriented part. So we'll see that as a separate over 30-40 minutes video where you will get this 7 to 12 marks. Then the safe harbor rules has not been tested till now, but it was tested in the old syllabus, but in new syllabus it has not been tested. That is not very complicated area and all. The safe harbor rules, maybe they could test it in MCQs or theory kind of something. The secondary adjustment is again not fully theory oriented, so it is a bit of problem involved. So both these areas, computation of ALP and secondary adjustment, in these two areas there will be some amount of problem solving which is required. The thin cap regulations, APA, they are a bit, I'll say that if associated enterprise, computation of ALP, secondary adjustment, or on the difficulty level kept as level 1, APA, safe harbor, thin cap and all could be kept at level 2. But at the examination level, they are being tested only at the rudimentary level, right? And generally there are two MCQs which is being tested in the new syllabus from this chapter alone. In this chapter alone, generally two MCQs are being tested. So this is the blueprint of this chapter. In the previous two exams, I have also analyzed the whole syllabus, but considering that only new syllabus is being weighted more. I'm not discussing that, but while solving problems, we'll take that also into consideration, right? So coming now, straightly jumping into the chapter. So this transfer pricing, the sections are from section 92 to 92F. So in the 92 to 92F, if you just see, I have just split the sections into two buckets. One is the major sections and the other one is the other sections. So whatever has been given here was the sections which was there when this scheme was initially proposed. The scheme was transfer pricing was actually proposed in the year 2001. Before that, there was nothing called as transfer pricing, right? So only in the year 2001, after all the liberalization, all those things happened in 1990s, the country of India felt the need for transfer pricing regulations. And one more difference which we could find between this specific part of income tax and other parts of income taxes, transfer pricing is not like highly, it does not highly involve interpretation of sections, or it is not like hard and fast rule that only this is to be followed, right? They are more based on business decisions and all, and even in the act or in the rules, they just give guidelines and not hard and fast rule. What is being provided in the act and the rules is just a guideline, and it is not hard and fast rules, as it is there in the chapter of PGPP, where if they just say that only these things are deductions, these things are not to be claimed as deductions. So all those hard and fast rules are not there, right? So let us just have a look at the section. Section 92 is going to speak about that is the first section. And generally, transfer pricing is known as SAR, which means the specific anti-avoidance rule. Transfer pricing provision. Generally, there are two types of anti-avoidance rules. One is general anti-avoidance rules, which is also a chapter in our syllabus, and the other one is specific anti-avoidance rule. So, anti-avoidance rule is basically an anti-abuse rule. Right? Somebody and this transfer pricing was mainly introduced to safeguard the base in the host country or the home country, right? So section 92 is the first section in the scheme of sections. I would not call it as a charging section. Section 92 is something similar to a charging section, because if I should call a section as a charging section, there should be an income which is to be charged. But under 92, no income is actually being charged, or a new head of income is not created. This is just imbibed into the five heads of income which is already discussed, which is already there: salary, house property, PGBP, capital gains, and IOS. Right. So next is section 92A. 92A speaks about what is an associated enterprise. 92B speaks about international transaction. What is an international transaction? 92C says how the arm's length price is to be computed. 92D says what are the documentation which is required to be maintained in this respect. 92E speaks about the accountant's report, and 92F speaks about the definitions. If you just see the other sections which are there between 92 and 92F is, first is 92BA, which is a specific, which defines specific domestic transaction. 92CA says how a reference is to be made to a transfer pricing officer from the assessing officer. 92CB speaks about safe harbor rules. 92CC speaks about advanced pricing arrangement. 92CD speaks about effect of an advanced pricing arrangement. 92C is going to speak about secondary adjustment, and 94B is going to speak about thin capitalization rules. So in the 92, 94B, we can say we could not outrightly say that this is a part of transfer pricing, but they are closely related. So I'm just putting it that way, right? So now first let us understand what is the reason for transfer pricing. So assume, for example, there are there is an international multinational entity which is having presence in country A and also in country B. So as a multinational entity who is going to have presence in both the countries, so in which country will I like to earn more income? In the country which I'm going to have less tax rates. Yeah. So basically, for a multinational enterprise, tax is an expense. So wherever I'm going to incur less expense, that is the country in which I would like to have more income. So let us take an example. Right. So first there is, assume for example, let me go to the whiteboard. Just give me a minute. Sorry. Whiteboard, whiteboard. No, this. So this is the whiteboard. Assume for example there is an entity A limited. A limited, so is in country A. Assume for example country A. So A limited is having two subsidiaries, B limited and C limited. So B limited is in country B, and C limited is in country C. So please bear with me for the handwriting. I'm just using the touch screen to write. So that is the reason why the handwriting is a bit. So please don't. Let us focus on the substance rather than the form. Right. So in country B, let us assume that the tax rate is 5%, and in country C the tax rate is 30%. And A limited is ultimately going to develop software and sell it. Okay, so in country C, the software is being developed for a cost of developing the software is 600, right? So the person to whom the software is going to be sold is D limited, right? So what should be the ideal situation and the selling price, the normal selling price of this software, say assume to be 1000. Normal selling price is 1000, cost is 600, country C tax rate 30%, country B tax rate 5%. Both of these entities held by A limited, which is there in country A. This is the brief facts, and this software is going to be sold to D limited, right? So what will be the ideal situation? So normal selling price is 1000, cost is 600. So what I'll do, I'm going to sell the software at rupees 1000 to D limited. Now what will happen in country C? I'll sell it at rupees 1000, selling price 1000, cost price is 600. So 400 is going to be my profit. This is the ideal situation. But what can A limited do is, they'll not go by this structure, because tax rate, this profit of 30 for 400 is going to be taxed at the rate of 30%. But what they would rather do is, they'll sell the software from C limited to B limited at 600, and B limited in turn will be selling this to D limited at rupees 1000. Now what is going to happen in country X, country C first? What is my selling price? 600. What is my cost price? 600. What is my profit? Nil. Right? Now let us come to country B. In country B, what is going to be my selling price? Selling price is 1000. Cost price 600. What is going to be my profit? 400. What is going to be my tax? 400 into 5%, 20 rupees. What is going to be my tax here? At the ideal situation, it is going to be 120 rupees. Tax is going to be 120 rupees. So as A limited, what would I want? As A limited, would I want a tax of 120, or would I want to pay a tax of, what is the tax amount? I guess there is some mistake. 5, 6, yeah, it is correct. 20. So why is A limited more concerned about taxes means? So what is the amount which is repatriable to A limited? So 400 minus 120, it is going to go for taxes, right? So it is going to be 280, which is the ultimate amount which is going to be transferred to A limited in the ideal situation. But in this case, what is going to happen is it is going to transfer 380. Instead of 280 being transferred to A Limited, 380 is being transferred if this structure is being organized, right? So, but what this country C Limited lose is a tax of rupees 100. So just to combat this situation, only the transfer pricing provisions were introduced, right? Now let us come back to this slide. So just to combat the situation, the transfer pricing regulations were used. So taxes are for the using the country's resources. For a country not to use tax due to multinational tax planning, which is said now, which is a classic example. So the transfer pricing provisions were introduced in the year 2001, right? So now let us go to the first section of the transfer pricing, which is section 92. So section 92 reads this way, where there is an income which is arising from an international transaction. If there is an income which is arising from an international transaction, it shall be computed having regard to the arm's length principle. So there are three terms which we need to understand here. What is an income? It is already defined in section 2, so we are not going into considering the possibility of time. But there are two other words which we do not know till now. First one is what is an international transaction. Second one is what is an arm's length price. So these are the two terms which we do not know, which we will learn in the due course. Right? So say explanation to section 192 says that allowances for expense or interest arising from an international transaction shall also be determined having regard to the arm's length principle. The reason why this explanation was introduced is because here it just read as income. Right. Let us go to the whiteboard which we are using. Where is the whiteboard? Yeah, this is the whiteboard. Sorry, just a minute. Just give me a minute. I'm just losing something. There's some problem with this laptop. So hopefully it is visible now. So where is this one? Go sure to the previous slide. Yeah. So if we just recall our example where we were speaking about what should be the selling price and what should be the cost price, there we just learned that income could be transferred, but just check the other way around. Assume for example software is developed in our example in country B and it is sold to country C. So while selling it to country C, if they are selling it at rupees 1000, again ultimately country C is going to lose. So, but what were the stand or understanding of few people was that here, since the term income is used, they were of the opinion that this is not applicable for expenses. But that was not the intention with which this scheme was introduced. Adhanala what they did is they just inserted an explanation clarifying that it is also applicable for expenses. After that, in the year 2012, they said that TP is also applicable for expense and interest by introducing a specific subsection. This was because of this Vodafone judgment, which is a very popular judgment in the Indian context. But let us not get deep into it because that is not required for the examination. Next is 92.2 speaks about what is TP is also applicable for a cost contribution arrangement. Cost to contribution arrangement is nothing but if assume for example there is A and there is B. If both of them together join and develop something, and they contribute cost to that specific development, and the benefits of that is going to be enjoyed by both of those entities, then such an arrangement is known as a cost contribution arrangement, right? So TP is also applicable for a cost contribution arrangement. TP is applicable for interest and expenses. Third point is very important point. It says that TP or the arm's length principle is not applicable if the effect is reducing the income chargeable to tax or increasing the losses. Why, sir? Why is this being introduced? I have already said the scheme of transfer pricing is SAAR, which once elaborated will give the meaning as specific anti-avoidance rules. So this is just for the country to protect its tax base. This is not similar to what we learn in NDS as fair value principle, nothing like that. Here it says that, or I'll put it this way rather, under section 92, what is being tried is they are trying to create a floor price. They are not trying to create the ceiling price. They are trying to create a price floor and they are not trying to create a price ceiling, right? So if at all, assume for example, I have done a transaction with an AE for rupees 100, but as per arm's length principle, the actual market price is 80. I have sold a good for rupees 100, but the arm's length price is 80. So what should be done now? Should I reduce this 100 to 80? As per 92.3, you are not required to do so. That's all. We'll end that discussion here. Right. So next, let us understand the term international transaction. So while understanding the term international transaction, the first line of that will read as an international transaction is a transaction between associated enterprises. An international transaction is a transaction between associated enterprises. So what is an associated enterprise is defined under 92. So 92 there are two subsections, 92A1 and 92A2. I am not getting into 92A1 because it is not required for the examination. But there are some good discussions whether 92A1 and 92A2 are two different ways to identify an associated enterprise. There are some very good judgments, weird gems, but we are not getting into all those things. Right? For the examination purpose, we need to remember this 92A2 section fully. Why, sir? Why should I remember? Because without remembering this, we cannot apply this concept and find whether two enterprises are associated enterprises or not. And incidentally, this question was tested in the near CMA final examination. Right? If you just see 1, 2, 3, 4, 3, 4, 5. Just 5 slides is going to give you some 5 to 6 marks. Can we not remember this? Just 5 to 6 slides. Just 5 to 6 slides. Or I'll put it will be from somewhere around 11 line items. Just 11 lines. If you remember 11 lines and a question is asked, you can easily get 6 marks. Right. So it is very, very important from examination point and also from the practical point of view. If you are going to analyze an international transaction and check whether this transaction is subject to transfer pricing regulations, first you need to check whether the entity with whom the transaction is made is an associated enterprise. Both from the examination point of view and from the practical point of view, this section is gaining so much importance. So much importance. Right? Now let us get into the specific details of this section. And this section I expect you also to remember the clause numbers. Right? It is if you just open the Income Tax Act, you could easily find it. I haven't given here for since it is a PPT, did not want to load more details. So that is the reason. But if you write even the clause numbers for this, it is going to give you a very good impression from the examiner. But if you are not able to do so, at least write as per 92A2. Here there is a typo. The section will be like 92A and subsection is 2. The brackets will not be there. There is just a typo there. Right? So it is like just as per 92A subsection 2, the companies are deemed to be. I just want that word also to be added for some reason. As per 92A2, companies or enterprises are deemed to be associated enterprise if, and then write what the condition is. We'll solve some questions in this respect. Okay. So let us get into the section. As per 92A2, two enterprises are deemed to be associated enterprises if one enterprise holds directly or indirectly shares carrying not less than 26% of voting power in the other enterprise. Let us go for an example. There is A Limited. A Limited is holding 26% in B Limited. In this situation, A Limited and B Limited are associated enterprises. That is what is being said, right? And there are some few specific nuances in this section which we'll understand now. So first it says that one enterprise. What does it say? One enterprise. This term enterprise is defined in section 92F. This term enterprise is defined in section 92F, right? And it is very broadly defined. There is one issue alone in the term enterprise. I'll discuss that in the next slide. Next is holds directly or indirectly. So the situation which I shown you now is holding directly. But uh, what do you mean by holding shares indirectly? Now let us see that. There is A Limited. A Limited is holding 100% in B Limited, and this B Limited is in turn holding 51% in C Limited. Without doubts, A Limited and B Limited are associated enterprises. A Limited and B Limited are associated enterprises because B Limited holds more than 26% in C Limited. Similarly, C Limited and A Limited are also associated enterprise. That is what is being tried by using the term indirectly. Okay, wow. Next is shares. What does it say? Shares. So since the term shares are used here, this specific clause is applicable only for companies. This specific clause is applicable only for companies and not for any other type of an enterprise, any other type of person. For example, for a firm, AOP, BOI, for all those type of persons, this specific clause is not applicable, right? So there ends the discussion. In relation to point 1, where one enterprise holds directly or indirectly shares carrying not less than 26% of voting power in the other enterprise. Now let us come to second point. Any person or enterprise holds directly or indirectly, already seen, shares carrying not less than 26% of voting power in each of such enterprises. What is the difference between first point and second point? First point says one enterprise. Here any person or enterprise in each of such enterprise. Only these two terms are not there. Now let us understand this with an example. Assume for example there is A Limited. A Limited is holding 51% in B Limited and 51% in C Limited. This being the case, B Limited and A Limited are associated enterprises based on the first condition. Right. Similarly, C Limited and A Limited are also related to each other, are associated enterprises, since it is holding more than 26% of voting power as per the first condition. Now, what this condition says is B Limited and C Limited are also related enterprises. That is what is being tried in this specific clause, where any person holds more than 26% in both of such enterprises, then each of such enterprises shall be deemed to be associated enterprise. That is what is being tried by this second clause. Okay, hope this is clear. Now let us go to the third point. Right. So these two clauses are applicable only for companies, but next is it is applicable for companies and also other types of persons. Right. Here also it is going to revolve around shareholding, voting power, etc. Right. So what first point says is where one enterprise is controlled by an HUF, the other enterprise is controlled by a member of such HUF or by relative of a member of such HUF. This term relative is actually defined in section 2. So it means husband, wife, brother, lineal ascendant or descendant. Husband, wife, lineal ascendant, descendant, brother, sister. That's it. That is the meaning of the term relative. It is defined in section 2. Right? So where one enterprise is controlled by an HUF, the other enterprise is controlled by the member of such HUF or by a relative of member of such HUF or jointly by such member and his relative, or jointly by such member and his relative. Let us take an example. There are few issues in that. I'll just come back to it. Right. Assume for example, there is a HUF. A HUF has 4 persons: A, his son, B, and his wife, C. There are 3 people in this HUF. A HUF. So what this A HUF is doing is, it is holding 35 percentage, or why 35, let us go for 100, it is 51 itself, is holding 51 percentage in, what to say, some name, we'll take it as H limited. H limited. So this A limited and AHUF and HHUF are associated enterprises. This is very clear. Now let us come to the second situation. AHUF is holding, first I'll erase this. Yeah, this is clear. AHUF is holding, yeah, so there is AHUF and this AHUF is holding 25 percentage in B limited. AHUF lo who are all there? A was there, B was there, who's his son, C was there. Totally there were 3 people. Here, this B wala guy is there, right? He is holding 51 percentage shares of this B limited. Okay, wow. Ipo, here what are all the relationships? B limited and B is associated enterprises, and B limited and AHUF is also associated enterprise. This is what is being tried here. Or assume for example, let us take another variant for this. In AHUF 25 percentage, B is holding 12.5%. C is holding 12 point, I'll say 13% for the sake of convenience. Okay. So C is holding 13%, B is holding 12.5 and A is holding 25. Even in this case, B limited and AHUF are related persons because B limited is controlled by the HUF and by a member of such HUF and jointly by his member and his relative. So that is what is being tried here. Okay. So now let us go to, there are some issues, but those things I don't think will be tested in the examination. So we are not getting deep into it. Next we will go to the next point, where one enterprise is controlled by an individual, the other enterprise is controlled by such individual or his relative or jointly by such individual and relative of such individual. As we seen earlier case there was HUF and HUF plus member of HUF plus relative variant was there. Here individual is going to control the enterprise and along with jointly with the relative. If he's going to control, those two enterprises are known as associated enterprise, is what is being said in this part. And the next part is where one enterprise is a firm, AOP or BOI. Where one enterprise is a firm, AOP or BOI, the other enterprise holds not less than 10% interest in such firm, AOP or BOI. இங்க வந்து பார்த்தனா where one enterprise in இருக்கு இல்லையா, this term enterprise will not include foreign LLP. That was the point which I was pointing out here. In the one enterprise ன்ற இடத்துல we cannot have foreign LLPs. LLPs incorporated outside India is not an enterprise, because in 92F it will say person. Person will include firm. Firm will include LLP which is incorporated as per LLP Act 2008. But company will include foreign company, but unfortunately LLP alone will not include foreign LLP. That is one point which we need to remember here. Next is, so these 5 points are in relation to voting power or shareholding pattern. Next is in relation to goods. So if there is I do manufacture or process a good, and the other enterprise is the owner in respect of which the other enterprise is going to have exclusive rights. Assume, for example, let us take an example here. There is Apple, there is Foxconn. Generally Foxconn is producing the goods for Apple. Apple phones are not produced by Apple, it is produced by Foxconn in India. Okay, so this Foxconn, whatever phones it produces, it is based on the patent, invention, or what to say, trademark, which is owned by Apple. So here Apple and Foxconn are related enterprises. It is what is being given in this part. Next is 90% of raw materials is supplied by the other enterprise. Assume, for example, I am producing rice, or take for example some what to say, a laptop or a car, something like that, and 90% of raw materials which I am going to use for this production is being given by one specified entity. In that case, me and that specified entity are deemed to be associated enterprises. Next is, I produce goods, and all the goods which is produced by me is sold to one person, or I sell it to a person who the other person says. Assume, for example, I am there, you are there. Okay. So now what I am doing is, I will produce the goods and I am selling all the goods to you. I am producing the goods and selling all the goods to you. In such case, you and me are related, no doubts. Let us take another example. I am there, you are there, your friend is there. So what is an agreement between you and me is, I am going to sell the goods to a friend. But what I am going to do is, I am going to ask you, or you are going to ask me to sell it to him. You are going to ask me to sell it to him at specified prices. Then even in this situation, even though the goods are not sold to you, since you are influencing the prices, you and me are related enterprises, what is given by the third point. Right? Clear? Totally 3 points in relation to goods. One is patent. I produce based on the other person's patent. Next is 90% of raw materials. Third one is manufacturing sold to the other enterprise fully. Okay. So next is in relation to loans and guarantees. In relation to loans and guarantees, if loan advanced by one enterprise to the other enterprise constitute not less than 51% of the book value of the total assets of the other enterprise. What does this mean? So assume, for example, you are there and there. A limited, B limited. Okay. So B limited or the total asset value is 100. 51 rupees, 52 rupees is loan which is given by the other person. The person who is going to give me the loan or associated enterprise is what is being given in this point. Very easy point. Next point is also easy. But the ஒரே point which we need to remember is 51% of book value of the asset. It is not the market value of total asset. So what do you mean by total asset? On which date should I take? It should be taken throughout the year. If at all on any date, right? You take the loan value on daily basis, you take the assets on daily basis. If at all on any date, your loan is 51% more than your asset, then your associated enterprise khatam ho gaya. There is no other way. You have to treat them as associated enterprises only. If at all at any point in time, the for more than 51% of the book value is represented as loans. Next is guarantees. So of my total borrowings, if 10% is guaranteed by a single enterprise, then me and that enterprise are associated enterprises. Next is in relation to board of directors. Here there is one specific point which I need to highlight. Okay. So first point is where more than half of board of directors are appointed by the other enterprise. Assume for example the board consists of 10 people and 6 people are appointed by the B Limited. A Limited 10 board of directors. B Limited is appointing 6 board of directors. Then A Limited and B Limited are associated enterprises. The point which I need you to focus here on is, assume for example there is an executive director. There are two types of directors, executive directors and non-executive director. If even one executive director is appointed by B Limited to A Limited, even one, in A Limited board there are 10 directors. Of this 10, if B Limited is going to appoint even a single executive board of director, then A Limited and B Limited are associated enterprises. Okay. The next point is more than half of board of directors are appointed by the same person. This is a similar point which we saw in relation to shares. A Limited, B Limited, C Limited. So if in B Limited, the person is appointing 6 directors. In C Limited also, the person is appointing 6 directors. Board composition is 10-10. In such case, A Limited and B Limited are related associated enterprise as per 1, and A and C are also associated enterprises as per 1. But B and C are going to be associated enterprises as per clause B. This is very similar to what we saw in shares. That is in relation to this point, right? So now let us go to, so with this, the associated enterprises, who are all the associated enterprises, comes to an end. Just to give you a quick recap, in relation to shares, there are two situations. In relation to shares, which is for every person, there are 3 situations, to totally 5. In relation to goods, there are 3, 8. In relation to loans and guarantees, 2. In relation to board of directors, 2. There is one more point which says that any other enterprise which the government may notify, but nothing has been notified till now. So you need not remember that. Right. This is in relation to associated enterprises. Now let us go to the next section where we speak about international transaction. This is the reason why we went to 92A itself. So where did we start? We started with 92. In 92, what did it say? It said that we understood income is already defined. We came to understand. We wanted to understand what is an international transaction. So to understand an international transaction, I said you that international transactions first line is going to be transaction between associated enterprises. So to understand this term associated enterprises only, we went to 92A. Now since that is done, now we are coming to 92B to understand what is an international transaction. Your general understanding of an international transaction and your understanding of international transaction term in the chapter of transfer pricing is to be different. In general terms, if a transaction is happening between two nations, that is to be termed as international transaction. But that is not the case in TP. First, let us understand that. Right. So as per 92B, a transaction is said to be an international transaction if it is between two associated enterprise. It should be between two associated enterprise of which either one of them or both of them should be non-resident. It should be between two associated enterprise, A Limited, B Limited, of which either A Limited or B Limited or both A Limited and B Limited should be non-resident. If A Limited and B Limited, both of them are residents, then this concept of international transaction itself does not arise. If the transaction is not an international transaction, I cannot go for 92. So for 92 to be attracted, there is to be 3 ingredients which is to be satisfied. First, there should be income. Then it is to be an international transaction. See here. So for 92, there are three conditions which is to be satisfied. First, there should be income. Next, there should be international transaction. And in that case, the income should be computed using arm's length price. Correct? So, if at all the transaction is between two residents, it is not an international transaction. If it is not an international transaction, then provisions of section 92 will not apply. Okay. So next is this will be given in your act as 92B1. This part, which is in the next side, it is 92B2, which says as deemed international transaction. This is an important point. What do you mean by a deemed international transaction? We have already seen that deeming is a fiction which is created by law. What does that mean, sir? It is not by itself or per se a specific, what to say, form, but law treats, as if it has achieved a certain form. Legally, பார்த்தனா இதுதான் deeming ஓட meaning. So, I don't understand all this. Just for this exam, what is to be done? We'll go for that. Deeming means assuming. அவ்வளவுதான். Assume it to be international transaction. What transaction should I assume to be an international transaction? That is what is given by 92B2. Simple words. Okay. A transaction entered into by an enterprise with a person other than an AE shall, for the purpose of subsection 1, which is this, be deemed to be an international transaction entered into between two associated enterprises if there exists a prior agreement in relation to the relevant transaction between such other person and the associated enterprise, or the terms of relevant transaction are determined in substance. The terms of relevant transaction are determined in substance between such other person and the associated enterprise, where the enterprise or the AE or both of them are non-resident, irrespective of whether such other person is a non-resident. Let us go to example. See, there are few permutation combinations which is possible in this deemed international transaction, but the concept is important from the practical point of view, but from the examination point it might not be tested. So what I'll probably do is I'll give you only one example. So there is A Limited. This is country A, COUNT, or country A. There is A Limited, and in country B itself there is B Limited. Ideally, what is to be done is A Limited wants to sell a product to B Limited, which is developed by C Limited. Ideally, what is to be done? C Limited will sell it to A Limited. A Limited will in turn sell it to B Limited. This is what will happen ideally. Correct? If this is going to happen, this transaction between A Limited and C Limited is going to be attracted, or it is going to be tested for transfer pricing provisions. So to avoid this, to avoid the transfer pricing impact in this for this transaction, what might happen is, what will A Limited say? If you are going to sell it to me, that is subject for transfer pricing. You rather what you do, you sell it specifically to B Limited. Directly to B Limited you sell. But for this transaction, I'll only fix the price. For the transaction between C Limited and B Limited, price is fixed by A Limited. Okay, va? So, இப்போ this specific transaction between B Limited and C Limited is a deemed international transaction. Deemed international transaction. This is what is being tested here. Okay, va? That is what is being said in 92B2. So let us not get more deep into this. There are also some other parts like what is a financial transaction, what are the types of transactions which was introduced in the year 2012 prior post to the Vodafone judgment. We are not getting into all those because that is not relevant for the exam, but I just want to bring it to your notice. When you're going to go for practice, you should read all those things, right? Next is section 92C. So I go to section 92C, again go to 92. 92 we had three terms: income done, international transaction done. Income is done. Income is done. Income is, we already know it. I don't think at final level we need to learn income. Next is international transaction is done. Now we have to learn for arm's length price. This term arm's length price is determined as per section 92C, and all these methods are prescribed in 10B. Okay, so 92C read along with rule 10B. That is where the arm's length price is to be determined. So to determine an arm's length price, what do you mean by an arm's length price? Simple as fair market value. Fair market value in transfer pricing terms is known as arm's length price. How should it be determined? There are totally 6 methods which is being given, and it is broadly being split into transaction based methods and profit based methods. Transaction based methods, there are 3 methods. First one is comparable uncontrolled price method, which is also known as CUP method. Next is resale price method and cost plus method. For profit based method, there are 3 types of methods. One is profit split method, transaction net margin method, and any other method. So first, what we'll do is we'll learn what is a comparable uncontrolled price method. So comparable uncontrolled price method is actually the most reliable method of arm's length price. So assume, for example, what was the purpose which we saw to be achieved in rather? It was very simple, that the transaction between the associated enterprises should be at fair market value. Remember our first example. The software example, 600,000 wala example. In that example, what we said, why this section was introduced, because the country did not want to lose its fair share of revenue. That was the reason. So for that reason to be achieved, in that example, what could have been done for the transaction between B limited to A limited, the selling price was fixed at 600, but the arm's length price, the fair market value is 1000. So what is the purpose of this transfer pricing provisions is they'll substitute this 1000 for the 600. Okay, so that is, and the 1000 they are going to substitute for 600 and compute the income. So that is the reason for this. Sorry, I just got a bit distracted. Sorry, yeah. So they wanted to substitute the 1000 for 600. That being the case, what will happen is, in all these 6 methods which we are going to learn, we are going to determine what is the arm's length price of a specified transaction. So first one is CUP, which is the most reliable method of transfer pricing. Here what it will say is, assume for example you are selling apple to apple, just in the apple, eatable apples between associated enterprise. Assume for example there is the same apple which is being sold by entity A limited is selling to B limited, A to B associated enterprises selling apple, and then C limited is selling to D limited also apples. This is being sold for 30, this is being sold for 100. So what we can simply do, A limited is selling to B limited apple, C limited is selling to D limited apple, rendume apple da. So since both being apple, what I'll say, 100 is the fair market value, you disregard your value and take 100 as your fair market value, arm's length price. That is known as comparable uncontrolled price. Right. There are 2 types of cup which is actually applicable. One is internal cup and the other one is external cup. Let us take an example for that. Assume for example, there is A limited. Right. A limited is selling goods to B limited. Okay. There is A limited, B limited. First, both of them are associated enterprises. First, A limited and B limited are associated enterprises, and A limited is selling goods. A limited is selling goods to B Limited. Okay. So when A Limited is selling goods to B Limited, there is another entity C Limited and another entity D Limited. Okay. So what is being sold here is Apple, for example. Similarly, what is happening is C Limited and D Limited are non-related enterprises, non-AE. Okay. Here also Apple is being sold. Here also Apple is being sold. So, and what one more thing is happening is A Limited is also selling to D Limited. A Limited is also selling D Limited Apple, and this is again a non-AE. Non-AE. So who are all AEs here? Wait, I'll just redraw this diagram for easy understanding using different colors. Yeah. So A Limited, B Limited are associated enterprises. Next there is C Limited. Next there is D Limited. Both of these are non-related enterprises. Okay, wow. So there are two transactions which is happening. First is between A Limited and B Limited selling of Apple. Right? C Limited is also selling to D Limited same apples. Okay. A Limited is selling to D Limited apples. Okay. A Limited is selling to D Limited. A Limited is selling to B Limited. C Limited is selling to D Limited. Now, what is the international transaction here? The transaction between A Limited and B Limited is the international transaction as per 92B. Correct? They are associated enterprises and they are situated outside India. So this is an international transaction. Now, this transaction between A Limited and D Limited is internal cup. Internal comparable uncontrolled transaction. The price which is being assumed here. So let us take prices here 60, 80, 90. We'll take this as prices. So this 80 rupees is internal cup, I cup, and this 90, the transaction between C Limited and D Limited, it is external cup, external comparable uncontrolled transaction, and this price of 90 is external comparable uncontrolled price. Okay, well, very simple. If there is a transaction between a party to the international transaction and to the third party, that is internal cup. If the transaction is between two unrelated entities, then it is external cup. Clear? Now let us get back to the slide. So there are two types of cup. One is internal cup and the other one is external cup. When the entity's transaction is with an independent party, that is an internal cup. When the external independent party's transaction with an independent party, that is called as external cup. Okay, well. So first one is we need to adjust for differences, if any, between international transaction and the comparable uncontrolled transaction, or between enterprises entering into such transactions. We'll understand this with while doing the problems. Let me not get deep into it. Next is adjustment is to be made only if it could materially affect the prices in the open market. So there are certain situations in which cup method can be best used. Best used is a perfect term, right? If there is interest, royalty, sale of listed security, transfer of goods, provision of services, in these cases cup can be best used. So for application of the cup method, there are certain preconditions which needs to be satisfied. First one is there should not be any differences in the transaction. If there is a difference between the comparable transaction and the international transaction, we should be reasonably able to adjust between these two transactions. Only in such case we can go for cup method. If not, we cannot go for cup method. Next, what is the cup? How should comparable uncontrolled price be computed? First, take the compare price in the comparable transaction. That is the third transaction. So you need to adjust it for material differences between comparable transaction and international transaction. Next is first is material differences in price. Next is material differences in the enterprises. If you are going to adjust both, you are going to get the arm's length price as per international transaction. Don't worry, we'll solve problems for this. At that point in time, you'll even more better understand. But for the time being, what we'll do is we'll close this specified video and we'll continue in the next video in relation to the other methods, and also we'll solve problems. Okay, fine. Bye bye. Have a great day.